In this video, we will talk about investing in bonds, both corporate and government bonds. Bonds are debt instruments, which means they provide fixed returns in the form of interest. Before getting into different types of bonds, we will go over a few key things about bonds. Governments and corporations issue bonds when they want to raise money, and are essentially asking for a loan. When you buy bonds, you are loaning them money, and they agree to pay it back by a specific date. For the length of the loan, they will also pay you interest along the way. Interest payments are usually paid twice a year. Bonds are traded on the secondary market and are considerably less volatile than stocks. Unlike stocks, which grant you ownership rights, bonds issued by corporations do not. So you won't gain net worth from the company's growth, but you also won't lose money when the company isn't doing well. So long as the company has resources enough to pay you back, you will gain income from the interest payments. If you purchase a bond, you can just hold the bond while collecting the interest payments. You can also purchase and sell bonds on the secondary market. Bonds' value will fluctuate after they are first issued, just like a stock would. The changes won't affect your interest payments, and if you are planning to hold the bond for the life of the loan, then this fluctuation doesn't matter at all. However, if you purchase and sell bonds on the secondary market, you should be aware that the price you pay or receive will no longer be the bond's face value. When choosing your bonds, it's crucial to take into account how susceptible the bond is to value changes. A bond's price and yield, the return you get from the interest payment, determine its value in the secondary market. The terminology of bonds can be complex, and what you need to pay attention to will depend on if you plan to hold or sell them. Here are some bond terms you should know. Coupon. The bond's interest rate is expressed as a coupon. After the bond is issued, it typically won't change. Yield. This is a measure of interest that accounts for the price fluctuation of bonds. The most straightforward way to calculate yield is to divide the bond's coupon by its current price, but yield can be measured in different ways. Face value. Commonly referred to as par value, face value is the amount the bond is worth at the time it is issued. The majority of bonds have a $1,000 face value. Price. This represents the price that the bond would fetch on the secondary market right now. The biggest factor to a bond's price is coupon rate. Now let's talk about types of bonds. As the name implies, government bonds are those issued by U.S. government agencies, state governments, or municipalities. Most bonds are issued by governments, and you will need to pay federal income tax on the income gained from interest payments. However, the interest is usually exempt from state taxes. Corporate bonds are the bonds issued by private companies in order to raise capital. Government bonds are considered the safest possible bonds as they are issued by the government. The government is on the hook to pay you back, and the likelihood of them going bankrupt is extremely low. Corporate bonds are less secure, but they also tend to offer higher yields. Investing in bonds is a great way to diversify your portfolio. It provides you with a steady stream of income from interest payments, as opposed to betting on a company's growth with stock purchases. Both are great investment opportunities, can be complementary assets, and should be researched thoroughly before you purchase. If you want to learn more about investing, check out some of our other videos. Leave a comment below to let us know what you'd like to learn next. Be patient with yourself, keep learning, and do what you can to better your financial situation. Thank you for watching.